Right now, the average 30-year mortgage rate is 6.69%. A lot of people assume that number is basically whatever the Fed wants it to be. The Fed moves its own rate. Your rate follows. That is not how this works. And there's $2 trillion reasons why. Buried in the Fed's own weekly report, it's a number almost nobody talks about. Before 2008, that number was zero. Not low, zero. In the next few minutes, I'll show you what that pile actually is, why it is shrinking in slow motion instead of getting sold off, and why that slow shrink is quietly adding real dollars to your monthly payment, whether you've ever heard of it or not. I'm a licensed mortgage loan officer. This is education, not financial advice for your specific situation. And any rate I mention here is published market average with a date attached to it. Not an offer, not a quote, and not a rate you're guaranteed today. One quick favor. If you've ever wondered why your rate didn't drop as much as you expected it to, tap that like button for me. It's free, it takes a second, and on this channel, this size, it's the whole difference between this reaching the next person, asking the same question, or not. And subscribe if you want more of these videos. Okay, let's get into the actual mechanics. Here's the assumption. Almost everybody the Fed sets the interest rate. So when the Fed cuts, mortgages get cheaper. And when the Fed holds or hikes, mortgages get more expensive. It's a clean story. It's also wrong, or at least incomplete. The rate the Fed actually controls directly is an overnight rate banks charge each other. Your mortgage is a 30-year bet. Those two things are related. They are not the same lever. What your mortgage rate really tracks is the 10-year Treasury yield, the government's own long-term borrowing cost, plus an extra markup on top. Right now, that 10-year yield is sitting around 4.61. Your mortgage rate is around 6.69. That gap, a little over 2 full percentage points, is called the spread. Think of the spread as a service fee. It compensates whoever buys your mortgage bond or the risk that you might refinance or sell early and hand their money back sooner than they planned. For most of the last few decades, that fee ran around 1.7 points. Right now, it's running over 2. That extra chunk, the part above the historical normal, is where today's story lives. So, who normally buys mortgage-backed securities? And why is the fee up? For most Americans, it was banks, pension funds, insurance companies, and foreign investors all bidding for the steady, boring return. Then 2008 happened, and for the first time ever, the Fed stepped into the market itself. Before the crisis, the Fed owned $0 of mortgage bonds. Zero. Its own balance sheet, every asset it owned was around $870 billion, mostly plain Treasury debt. After 2008, and then again through the pandemic, the Fed bought mortgage bonds on a scale that had never happened before, becoming, for a while, the single largest buyer of mortgage-backed debt on earth. At the peak in the summer of 2022, it was holding $2.71 trillion of them. As of this week, its own balance sheet is reporting around 1.93 trillion in the mortgage bonds still on the books out of 6.75 trillion in assets. It has shed about 780 billion since the peak, and it's still not back to anywhere close to zero. And real quick, that's the whole pitch here. Today's video is brought to you by me. There's no sponsor for this video or this channel. Is my business. I'm a licensed mortgage loan officer, and this is generally what I do all day. If you'd like to speak with me, book a free call. You can book a 15-minute call, no pressure, no pitch, and I'll walk you through your actual numbers with you. My free payment calculators are linked down below too. Scan the code on the screen or tap the link in the description and in the pinned comment, which is the comment at the top. All right, let's get back to it. Now, here's the part people get wrong, including the title of this video. Before I talk myself out of it, the Fed is not marching into the bond market and dumping these for sale. It's doing something quieter. Every month, some of those old mortgage bonds pay down naturally. Homeowners refinance, they sell, or just pay off principal. Normally, the Fed would take that cash and buy a fresh mortgage bond to replace it, keeping the pile the same size forever. Since 2022, it's mostly stopped doing that. It lets up to $35 billion a month just melt away, uncollected, unreplaced. It's less than a landlord evicting tenants. It's more like a landlord who quietly stops renewing leases at the end. The apartment doesn't get seized, it just isn't Fed's problem anymore. And that's exactly the issue, because somebody else now has to be the buyer. For every new mortgage getting written in America without the Fed showing up as a guaranteed customer, it used to be. New buyers can be found, they just want a better price for taking on a role. The Fed used to fill almost automatically. That's your extra spread. Let's put actual numbers on this, because a wider spread is abstract and a mortgage payment is not. Say you're financing $400,000 on a 30-year fixed. At today's rate, 6.69% principal and interest, run about $2,578 a month. If the spread came back to its old historic normal of 1.7 points, that 10-year Treasury, same loan, just a rate around 6.31 instead. The payment drops to about $24.79. That's roughly $100 a month, about $1,200 a year. Gone on an identical loan, an identical buyer, and identical Treasury yield, just because of where the spread happens to be sitting right now, instead of where it usually sits. Now, I want to be straight with you, because if I stopped here, I'd be overselling the villain. The Fed's still shrinking pile of mortgage bonds is one real well-documented reason. The spread has stayed for a while. It is not the whole one. Mortgage bonds also got riskier to hold simply because interest rates themselves have been more volatile. Nobody knows exactly when homeowners will refinance. So investors charge extra for that uncertainty too. And banks, who used to be the big natural buyers of mortgage bonds, have been holding back some of that money since the bank stress of 2023 changed how the risk gets treated on their books. The Fed's balance sheet is a real ingredient in this. It's not the whole recipe. Here's where it stands right now. In December of 2025, the Fed actually stopped shrinking its Treasury holdings entirely. That part of quantitative tightening is over, but it made very specific choice to keep shrinking the mortgage side, still capped at $35 billion a month. So the mortgage pile keeps melting even while the rest of the balance sheet stabilizes. For that spread to come back down towards its old normal, one of few things probably has to happen. The Fed has to actually finish shrinking that pile and settle into a steady state. Rate volatility has to calm down, or banks have to come back in as buyers. None of those are things you can control, and none of them are guaranteed to happen on any particular timeline. So what do you actually do with this? Stop reading a Fed rate cut headline and assuming your mortgage rate is about to match it. Those two things share a neighborhood, not an address. Watch the 10-year Treasury yield. If you want the real base number and understand the extra markup on top of it is being kept artificially wide, in part by a hangover from 2 rounds of emergency bond buying, nobody's fully unwound yet. And remember, the thing that never changes in any of this, your rate is a rental fee on money, and rental fees can be refinanced later. If you buy now at today's spread, and it eventually narrows, you go get the better rate. Nobody refinances the price they paid for the house. Quick disclosure recap here though. Every dollar figured in the loan example of $400,000 loan, 30-year fixed, principal and interest, only 0 points and 0 lender fees. So the annual percentage rate equals the note rate in this example. The Fed balance sheet figures are from this week's own balance sheet report. And the rate figures are Freddie Mac's weekly survey, both dated, both public. Your actual rate, your actual spread, and your actual payment will depend on your own credit, your own loan, and the week you lock. So here's the actual takeaway. Your mortgage rate isn't broken and it isn't purely political. It's a downstream of the market the Fed itself distorted more than any central bank ever had before 2008, and it's still slowly, quietly working its way back to normal. 1.93 trillion is still sitting on the Fed's books. It's receipt for that. When that number keeps falling and the spread finally comes back towards 1.7, that's the real signal to watch, not the next headline about a rate cut. I'll see you in the next one. It still owns $1.93 trillion of mortgage bonds.